Hello traders, this is Fawad Razak, market analyst for City Index. Today is the 25th of March 2024. Crude oil is looking constructive. Following its retreat from a multi-month high last week, it is bouncing right where it needed to in this shaded blue area, which was previously resistance. As you can see, it's now offering support. So ideally, from a bullish point of view, you don't want to see prices go back down and retest this area again, because we've seen a big or a decent rally of 1.8% so far. But if it were to do that, technically it wouldn't end the bullish trend for as long as it doesn't go on to break the most recent low, which comes in at 76.41, which is now miles away from where we are at the moment. So from here, some of the bullish targets include last week's high at 83.12, followed by the 61.8% Fibonacci retracement level at 84.40, and then thereafter you have the psychologically important $85 level, and so on. On the downside, I spoke about the importance of this area. So 80.65 is the high from March, 1st of March, which has now been tested on a few occasions, and so far it has held. Below that we have the psychologically important 80 level, and then thereafter you have the 200-day moving average and the base of the previous breakout at 79.25. So those are some of the key levels to watch on the downside should oil prices head lower from here. Here's a weekly chart of gold. The precious metal last week hit a new record high at 2,222 before pulling back a little bit. It eased off from those highs because of profit taking and also because of a rebound in the US dollar. The trend is clearly bullish, with the precious metal finally breaking this area of resistance that had held price back on multiple occasions in recent years. At around, it's this area here, at around 2080 or thereabouts. Once it broke through that area, we saw a sharp continuation to the upside. Prices went on to take out the December high, where it then bounced from on a small pullback before heading higher again. So from this weekly chart, you can see that the December high at 21.46 is a key support level, a short-term support level. Below that, this is the most important region to watch should we go below the December low at 2080-ish to 2075. This is the former resistance range, which could turn into support on a potential retest. So a lot of people will have potentially missed out on this pullback, and even the bulls wouldn't mind seeing a bit of a pullback because prices do look a little bit overstretched on the upside. So if I show you the daily chart, you can see that the RSI, the relative strength index, recently went into the overbought territories. So a bit of a pullback will not hurt anyone. So ideally, from a bullish point of view, what you want to see is a consolidation at these highs rather than a sharp pullback to work off those overbought conditions, because remember, the RSI can work off its overbought conditions through time as well as price action. If it does it through time, this is considered to be more bullish than a pullback of some sort. So from here, where do we go? As I mentioned, support at 21.46 needs to hold to keep the bullish traders happy in the short term. But even if that level were to break down on a daily closing basis, this would not necessarily end the bullish trend for as long as this key support area holds at around 2080, as I mentioned. On the upside, 21.95 is the high from 8th of March, which briefly broke down on Thursday of last week before price pulled back below it. So that level is now going to be important insofar as short-term resistance levels are concerned. Above that, we have the record high, and then you need to go to your weekly time frame again and look at some Fibonacci extension levels, such as the one I've plotted on this chart, using this swing high from August 2020 to September 2022 low. I've got the, in fact, the 127.2% Fibonacci extension has already been tested, hasn't it? The 161.8 of that extension comes in at 2,360. And then, if you think about how long prices have remained in this consolidation, it may sound a little bit crazy, but it could get to the 200% extension at some point as well. I'll leave that there for now. We are miles away from it, I know that, but we could get there at some point should the bullish trend continue. So whether gold can continue rising will depend, at least to some degree, on the direction of the dollar. The US dollar index last week closed higher following dovish policy decisions from the Bank of England, the Swiss National Bank, and the RBA, and so on. Looking at a few currency pairs, the euro dollar has not been anywhere fast in the last several months, even quarters. So right now it is testing resistance around 108.35, which is the 200-day moving average and price support. This level now needs to be reclaimed by the bulls if we are going to see the euro dollar pull back and rise back towards this bearish trend line. But if this level turns into resistance, then there's a danger it could break this black line at 107.95, which was the low from 29th of February, and that was the last kind of low prior to the move up. So a move below that level I think would be bearish in the short-term outlook anyway. So for gold investors as well, they'd want to see a strong euro dollar rather than a weak one. Now the euro dollar itself is not looking very interesting, but I'll tell you one currency pair that is looking quite interesting, and it's this one, the euro Swiss. The euro Swiss has been rising for several weeks now because they have been anticipating the Swiss National Bank to turn dovish, and so they have. They cut interest rates last week, didn't they? And surprised everyone with that rate cut, causing the Swiss franc to weaken across the board, including against the euro. So the euro Swiss franc broke above this key area of resistance between 96.80 to 96.94. This area is now being tested as support, and so far it's holding firm. So the path of least resistance on the euro Swiss is to the upside as things stand. So from here, the next target would be the liquidity from last week's high at 97.87. So above that, the next logical level would be the 98 handle, and then from there we could go on to reach the next round handles like 99 and even parity at some point down the line. Above parity, we have last year's high, which it was made in January of that year. So those are some of the key levels to watch on the upside. On the downside, I mentioned the importance of this area of support. Now, for as long as that holds, it's all good, but if it breaks down, then we could well see some short-term weakness back down to 96.30, which was previously support and resistance. Below that, you have the 200-day moving average and support at 95.50-ish. For more analysis and trade ideas, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.